The U.S. trading session for August 25th has come to a close. Before we analyze the data, a mandatory disclaimer. This trade plan is a theoretical exercise and my personal market view. It is not financial advice. Markets have largely stabilized following the localized selling pressure we saw earlier in the month. This stability is the result of a market idling in place, with price action currently tied to external signals rather than internal momentum. We are watching a holding pattern where established technical levels are becoming secondary to an approaching macroeconomic gauntlet. Looking at the broader indices over recent sessions, you see a consistent upward drift in price. For intraday traders, this represents a period of volatility contraction. Trading ranges are narrowing, and the daily spread between highs and lows is shrinking. Even as price rises, momentum remains thin, with little evidence of broad market participation. This drift characterizes a market where institutional capital remains parked, waiting for clarity before committing to a specific direction. To understand the quality of this recovery, we have to look at the volume profile of the S&P 500. This hourly chart highlights the sharp distribution and price drop on August 21st. Since then, price retraced in a steady upward drift. The chart also tracks volume at the bottom. Note how volume bars consistently decreased even as price climbed. This is a clear volume divergence, where price and market participation are moving in opposite directions. Rising prices on declining volume suggest a lack of active selling pressure rather than a surge in institutional buying. A recovery without volume support leaves the index vulnerable to a sharp reversal if a new catalyst emerges. If the broad market isn't buying this recovery, we need to look at market internals to see who is. This heat map reveals how performance is distributed across sectors. We see significant relative strength concentrated within the semiconductor sector. A small group of tech giants is sustaining the broader index. Meanwhile, traditional safety sectors like energy and consumer defensives are lagging behind. This divergence shows that risk appetite is concentrated in a very narrow segment of the market. Concentrated participation means that any negative catalyst for the leading sector can quickly impact the broader market. Why is institutional capital remaining on the sidelines despite the rising price action? This hesitation corresponds directly with the upcoming schedule of high-impact data releases, specifically the U.S. core PCE price index and preliminary GDP. These inflation and growth metrics directly influence the Federal Reserve's interest rate projections. Later in the week, the market shifts focus to the Jackson Hole Symposium. The potential for central bank policy shifts is currently the dominant factor for market participants. Traders are closely monitoring the calendar for remarks from Federal Reserve officials that might clarify the path of future rate hikes. The low volume we observed on the charts is the market pricing in the risk associated with these binary events. With these catalysts approaching, any directional bias based solely on the current chart has a high risk of invalidation. We can now define a rule-based plan for the August 26th trading session. The NASDAQ 100 will be our focal point, as it is highly sensitive to both tech performance and interest rate expectations. In the bullish scenario, a cool PCE reading could catalyze a breakout above local resistance. In the bearish scenario, hot inflation data or hawkish Fed commentary would likely lead to a breakdown below recent support. For the August 26th session, the tactical approach is to remain neutral and reactive. Avoid attempting to anticipate or front-run the macroeconomic data releases. In an environment defined by binary macro events, taking a heavy directional bet is an unnecessary risk. Price action leading up to Wednesday's data will likely be characterized by choppy, sideways ranging. Intraday strategy involves mapping the outer boundaries of the current one-hour consolidation zones. Look to trade mean reversion at these edges, as low-volume breakouts are frequently met with reversals. Reducing market exposure is the most logical path for this session. The priority is preserving capital ahead of the expected volatility. High-probability directional opportunities will emerge only after the market has fully processed the macro data. Waiting for a new trend to confirm provides an entry point with clearly defined risk parameters. A professional edge comes from knowing when to trade and knowing when to let catalysts clear the path.